What are Warren Buffett's investment tenets? Does he really have specific 12 guiding principles for investment success? Robert Hagstrom captured this mindset in the Warren Buffett way by distilling Buffett's approach into 12 practical tenets. I'll share all of them in this video with practical examples for each one. The tenets are placed in 4 pillars: business, management, financial, market. You don't need a PhD to use them. You just need patience, common sense, and the discipline to say no most of the time. Warren Buffett didn't set out to be a stock picker. He set out to be a business owner. That one shift changes everything. When you stop thinking in tickers and start thinking in companies, your attention moves to the only thing that matters: what the business does, how it makes money, how strong it is, who runs it, and what price you're paying. These lessons came to Buffett after he read The Intelligent Investor by Benjamin Graham. A share is a slice of a company. If the company wins for many years, your slice grows in value. If the company is weak or you overpay, no clever trade will save you. Buffett's mindset: own fewer, better businesses for much longer and let compounding do the heavy lifting. Buffett, as any other value investor, does not depend on diversification to protect himself. His protection comes from the analysis he does, not from owning a lot of subpar businesses all at once. The first tenets are in relation to the business. The first question we must ask ourselves is the business simple and understandable? Simple doesn't mean small. It means you can explain how it makes money without a spreadsheet. If you can't sketch the model on a napkin, you're outside your circle of competence. If you cannot truly explain the way a software company is making money, it has to go in the too difficult pile. Never be afraid of not investing in something, especially if you cannot understand it, as Charlie Munger would say. And never forget Warren Buffett's quote: "Investing is not baseball." When playing baseball, if you miss the swing 3 times, you're out of the game. But when investing each year, you get multiple shots to hit an undervalued target. It is more important to swing when it is obvious, and the investment decision is bulletproof. In investing, the first and golden rule is to never lose money. The second rule is to never forget the first rule. By missing out on profits, you are still in the game. By losing money, you're out of the game. Plus, in investing, you don't receive any penalties for waiting. This is the key edge value investors have: the power to wait for investing in the right vehicle, and the power to wait after investing so that we capitalize on the big long-term returns. Also remember that Buffett and Munger like 1-foot hurdles, not 7-footers as they say. They want easy investment decisions, not hard and difficult ones. Quick test: if a friend asked, "How does this company make cash?" Could you answer in 30 seconds? The second question here to ask is, does it have a consistent operating history? Buffett prefers companies that do the same useful thing year after year. That doesn't mean zero change, it means predictable economics. Railroads move freight, insurers underwrite risk. A good past doesn't guarantee a good future, but a messy past makes a steady future unlikely. Red flag to note: constant pivots, new product fads, or revenue that depends on one-time deals. The last key question to ask here is, are the long-term prospects favorable? Over time, pricing power and a moat decide who keeps their profits. I have a separate video here on the channel regarding the 8 types of business moats. These 8 factors determine if a business has a real competitive advantage or not. Check the video after this one. It is down in the description. Great businesses sell something people want, that's hard to replace, and isn't capped by heavy regulation. Commodity businesses, where products are the same and competitors set the price, may look busy but earn thin returns, which is not ideal. The quick test here is to ask the question: if the company raised prices 5% tomorrow, would customers stay? I have shared a free checklist PDF you can download in the description of the video. It goes through Buffett's key metrics he uses when evaluating the risks of a business. He first checks the balance sheet. I'll make a pinned comment with the free checklist or grab it from the link in the description. After the business tenets come the management tenets. A question here you must answer yourself is, does management act rationally about capital? The most important job of leaders is capital allocation. Every dollar of profit must go somewhere. There are 5 ways a company can allocate capital. First is back into the business, into acquisitions, into buybacks, into dividends, or left as cash. Rational managers compare returns. If reinvestment can earn high returns, they keep the cash. If not, they may be reinvesting in low-return projects, overpaying for acquisitions, or buying back stock at dumb prices. Buffett's lens is to make sure retained earnings are earning above market returns. This is also closely linked to return on equity and return on invested capital. The last 2 principles are both placed in the market tenets bucket. The first one of them is to estimate the intrinsic value. Remember, price is what you pay. Value is what you get, and the value means the present value of all the cash the business can deliver to owners over its life. Predictable cash flows, think beverages or consumer staples, are easier to value than boom-bust stories like tech stocks. Buffett is famous for not investing in tech, but not because he cannot understand the business, but because he cannot predict the chance of this new technology being here in 10 to 20 years, and more importantly, if the business behind it to make a good profit from it. For example, the internet in the 90s was here to stay, but 99.9% of all companies from that era failed. Only two good examples are left, which are Google and Amazon. Plain approach, make a sober range. Don't force precision, you need a ballpark, not a microscope. The last, but certainly not the least important principle, is to demand a margin of safety. Even wonderful businesses can disappoint. Buy below your estimate of value so normal mistakes don't sink you. This is Benjamin Graham's idea, sharpened by Buffett's patience. What is the everyday picture? If you think a house is worth $200,000, don't pay $199,000. Aim for $160,000 to $170,000 so the roof, the plumbing, and your own errors are covered. Subscribe for more and watch my other even more practical videos on the channel.